Okay, let's dive right in. This morning, the market is, well, balanced precariously. We've seen indices nudge up towards those all-time highs recently, but there's one piece of news dropping any minute now that is absolutely critical.
hmm
It's set to dictate the market's mood and direction, not just for the next 24 hours, but potentially for longer.
Exactly. It's a moment where the big picture macro trends, specific company news, and shifting investor sentiment are all converging. That creates both opportunity and significant potential for sharp moves.
Our mission today is a deep dive into a stack of sources, primarily a detailed market analysis and trading plan report from this morning, June 11th, 2025. We're focused on the immediate short-term outlook for U.S. stocks, looking at the window from 9 a.m. ET today through tomorrow morning.
Right.
We're going to unpack the key forces at play, highlight specific stocks showing significant activity, and translate this complex picture into a clear scenario-based action plan.
Think of it as getting the essential insights, the what matters most right now, without having to sift through everything yourself. We're going to show you the connections and the potential paths forward.
So, setting the scene. The market is approaching the session with, let's say, cautious optimism, buoyed by recent gains. But according to the analysis, the big picture remains shaped by familiar themes.
That's right. We're still dealing with persistent inflation, although, it's shown signs of moderating lately.
Yeah.
We also have a labor market that's cooling just a little.
Right, those jobless claims.
Yeah, jobless claims rose to an 8-month high recently, but it remains pretty tight overall. Overlaying all of this is a Federal Reserve that is explicitly data-dependent, scrutinizing every new number for clues about its next policy move.
And of all the data points the Fed and the market are watching, the source identifies one as absolutely central to today, the May CPI data release, due out at 8:30 a.m. ET.
hmm
The report calls this a crucial checkpoint. Why is this number so important today?
Because the market has expectations built in. Economists are projecting headline annual CPI around 2.4% and core CPI around 2.9%. Any significant deviation from those numbers, particularly if inflation comes in hotter than expected, will immediately recalibrate expectations for the Federal Reserve.
Okay.
A hot number reinforces the idea that interest rates might stay higher for longer, which impacts borrowing costs, business investment, and ultimately stock valuations.
And the flip side, a cooler number.
A cooler number would be taken as confirmation of disinflation, potentially bringing rate cut expectations slightly forward, which is, generally bullish.
And recent signals have made people a bit nervous about that cooler number, right? There's some conflicting data points floating around.
Precisely. The Cleveland Fed's inflation nowcast, updated just yesterday, actually projects June CPI slightly higher than the May consensus and core CPI just over 3%.
Oh, interesting.
We've also heard Fed officials like Atlanta Fed President Bostic say inflation is still somewhat above their target. This is why the market is so sensitive to today's print. These small differences from expectations are currently, well, everything.
You mentioned the labor market showing a tiny bit of cooling. How does that factor in?
Well, the Fed wants to see some easing in the labor market as a sign that price pressures are diminishing. Chairman Powell has been clear that they're in a holding pattern on rate cuts for 2025, waiting for more concrete evidence that inflation is sustainably headed back to target.
Right, they need more proof.
Exactly. So while some labor market cooling is positive, if today's CPI comes in hot, that single data point will likely dominate the narrative and could reinforce the higher for longer view despite the slight softening in jobs data.
We also can't ignore the U.S.-China trade situation, which seemed to positively impact things yesterday, especially in tech.
Yes, the market reacted favorably yesterday, especially the semiconductor sector, on hopes that trade restrictions might ease. The source notes that a degree of optimism about trade seems priced into the market right now.
But there's a flip side to that coin, isn't there? A risk.
Absolutely. The report highlights that ongoing trade tensions pose a persistent risk of slowing economic activity. Plus, tariffs themselves can put upward pressure on prices, tying back into the core inflation concern.
So it cuts both ways.
It does. So, while yesterday's sentiment was positive, any negative trade headlines could quickly become a headwind, particularly if combined with a hot CPI number.
Okay, so putting it all together, CPI today is the biggest, most immediate factor. Labor is cooling slightly, but still relevant. The Fed is waiting on data. Trade talks are a volatile variable.
That leads the analysis to lay out 3 high-probability scenarios for the next 24 hours. And it's crucial to understand these are contingent on that CPI number dropping this morning. The probabilities assigned are before we get that data.
Okay, walk us through them. What's scenario one?
Scenario 1. Inflation moderates. This is the more dovish outcome. The trigger is the CPI data meeting or coming in below expectations, say headline at or below 2.4%, core at or below 2.8%.
Okay, the good news scenario, basically.
Right. This supports the view that inflation is cooling, could lead to a more dovish tone from Fed speakers later, and potentially pull forward expectations for rate cuts. The market reaction would likely be bullish for stocks, especially growth sectors. You'd likely see bond yields fall and the dollar weaken.
And the probability on that one, pre-CPI.
The report puts the pre-CPI probability for this at 35% with a clear bullish bias.
And the opposite, scenario 2.
Scenario 2, inflation persists. This is the hawkish outcome, weighted higher in the report at 45% pre-CPI, partly due to those recent data points like the Cleveland Fed's nowcast and cautious Fed comments.
So a higher chance of bad news initially.
According to this analysis, yes. The trigger is CPI data exceeding expectations, headline above 2.5%, core above 3.0%. This reinforces the higher for longer story, could lead to more hawkish Fed commentary, and pushes rate cut expectations further out.
And the market reaction?
Likely bearish, a potential pullback in stocks, with defensive sectors possibly showing relative strength. Bond yields would rise, and the dollar would strengthen. The bias here is bearish.
And the middle ground, scenario 3.
Scenario 3, mixed signals or sideways. This happens if CPI is right in line with expectations or mixed in its details, maybe headline hot but core in line, and there's no other strong news out of the gate.
So sort of a muddle through?
Kind of.
Yeah.
The Fed's stance remains unchanged, still data-dependent. The market might consolidate or trade sideways, with movement driven more by individual stock news or sector rotation rather than a clear, broad direction. Pre-CPI probability for this is 20%, with a neutral to slightly defensive bias.
So that CPI number isn't just a statistical release, it's the event that will likely shift the entire framework, immediately changing the probabilities of these scenarios playing out.
Absolutely. It's a crucial inflection point for the next 24 hours. The market will react sharply as it digests the number and its implications for the Fed and those scenarios.
Looking back at yesterday, Juneteenth, the major indices finished mostly positive, helped by that tech and semiconductor strength we mentioned. The S&P 500, Nasdaq, and Dow all finished in the green.
Right, with the S&P and Nasdaq flirting with all-time highs again.
But you said that strength was concentrated.
Very much so. Leading sectors yesterday were technology, particularly those semiconductor names like Intel, which jumped nearly 8%. Energy, communication services, and consumer discretionary also saw gains.
And lagging, what was weak?
Industrials were weaker, partly due to stock-specific news like J.M. Smucker's earnings miss, which set that stock down significantly. That happens.
How does the analysis expect sectors to perform after the CPI number based on the scenarios we discussed? What's the rotation play?
Okay, so if we get the cool or inline CPI scenario, that dovish neutral tilt, the report expects renewed interest in growth sectors like tech, XLK, discretionary, XLY, and communication services, XLC. Rate-sensitive sectors like real estate, XLRE, and utilities, XLU, might also benefit from potentially lower yields.
Makes sense. And if CPI is hot, the hawkish outcome.
In the hawkish higher-for-longer scenario, the likely rotation is towards defensives, consumer staples, XLP, healthcare, XLV, utilities, XLU. Financials, XLF, might see some relative strength with rising yields, but overall a broad risk-off move is more likely. Energy, XLE, is a bit mixed, sometimes seen as an inflation hedge, but also susceptible to economic slowdown fears.
The report also mentioned that interesting dichotomy in tech yesterday, the rally versus underlying ratings.
Yes, it's a key point. The big rally in semiconductor stocks yesterday was very event-driven, tied to that U.S.-China trade optimism. But the report notes that some analysis shows the broader tech sector has underlying cautious factor ratings right now, scoring negatively on things like value and sentiment.
So the rally was fragile.
It suggests yesterday's move was based on specific news and emotion, and that part of the sector could still be vulnerable if the broader market is hit by a hot CPI reading. It's a classic example of conflicting signals you have to navigate.
Okay, let's get specific then. The analysis highlights 5 stocks poised for significant action in this 24-hour window, based on a first principles look at their price action, news, sentiment, catalysts, all that stuff.
Right. These are Intel, Novo Nordisk, Sterling Infrastructure, Calmain Foods, and Palantir. It's about identifying why these particular names are relevant and potentially volatile right now.
Let's start with Intel, INTC, trading around $22.08 this morning. What's the story there? Semiconductor bellwether.
Intel is a key player in semiconductors, obviously sensitive to U.S.-China trade dynamics, and part of the broader AI narrative. Its relevance exploded yesterday when it surged almost 8%.
And that surge was driven by
Optimism around potential easing of U.S. export restrictions on chips to China, plus some positive analyst commentary. What really stands out is the volume over 171 million shares traded yesterday.
wow, that's huge.
Yeah, that's not retail noise. That's significant institutional money moving, suggesting strong conviction behind the trade optimism catalyst. Sentiment was definitely hope and optimism.
And technically,
Technically, that move broke Intel above key moving averages, like the 50 and 200-day lines on massive volume. It's a classic bullish signal. Quantitatively, short interest is relatively low compared to peers, meaning less potential fuel for a short squeeze right now.
okay. Next, Novo Nordisk, NVO, around $74.63. The GLP-1 giant, everyone's watching these.
Yeah, NVO is a leader in the booming weight loss drug market. Its relevance is extremely high right now due to two new powerful catalysts. First, it jumped significantly yesterday on reports that activist investor Parvis Asset Management is building a stake, potentially looking to influence CEO selection.
And activists getting involved, okay.
And second, anticipation is building for crucial clinical trial data on its next-gen GLP-1 drugs, Wegovy high dose and CagriSema, expected very soon, specifically June 20th to 23rd.
So activist pressure and major data anticipation, that's a double whammy.
Exactly. We saw big volume yesterday, too, over 9.5 million shares. Sentiment is high anticipation and speculative interest ahead of that data. Technically, the stock is bullish after yesterday's rally.
What about the quant side, options?
Quantitatively, implied volatility in the options market is high. That's the market signaling it expects a big move due to the binary nature of those upcoming trial results. Recent unusual options activity leaned heavily towards calls. This is a classic event-driven setup.
Right, where the outcome is almost binary.
Exactly. Standard price targets might be less relevant than the potential for a large re-rating based on fundamental new data.
Okay, third stock, Sterling Infrastructure, STRL, trading around $202.91. Known for infrastructure, especially data centers.
STRL has strong fundamental momentum, particularly in its E-infrastructure segment, which serves data centers. While not yesterday's headline grabber, it's been a high-momentum name, up significantly over the past year.
And there's new news.
Yes, and notably, this morning, June 11th, the company announced an extension and expansion of its credit facility. This reinforces the positive fundamental picture after strong recent earnings.
So fresh news supporting existing momentum.
Yes. Volume on June 9th was above average, showing sustained interest. Sentiment is positive, driven by fundamentals and momentum. Technically, it's in a very strong uptrend, hitting new 52-week highs.
But there's a catch.
Well, the report notes a technical signal to watch. The Relative Strength Index, or RSI, is over 70, which often suggests the stock is overbought in the short term and could be due for a pause.
Ah, okay. A potential conflict there.
It's a technical warning sign conflicting with the strong fundamental and price trend. Quantitatively, institutional ownership is very high, and there's been recent insider buying signaling confidence from those closest to the company.
Interesting. Okay, Cal-Maine Foods, Call M, around $97.55. The egg producer. Why this one?
Cullum has seen strong recent momentum, largely tied to egg prices and its fundamentals. It was also flagged as a high-momentum stock. The analysis highlighted it for its high growth and positive technical setup, citing strong growth metrics and positive analyst revisions, even if volume yesterday was below average.
So fundamentals and technicals look good for potential upside, like a breakout candidate.
That's the picture the report paints. Sentiment is positive based on that growth, and the technical setup suggesting a potential breakout. Technically, it's consolidating just below resistance around $9,900. A move above $99.65 is identified as a key breakout trigger. TradingView's technical summary is strong buy.
But is there a but here too?
There is. A point of divergence the report highlights is that the average analyst price target is significantly below the current stock price, which is, well, unusual for a strong rally.
Huh. That is odd.
And quantitatively, institutional ownership is very high here too. But there has been some recent insider selling, which contrasts with the insider buying at STRL and adds another layer of complexity or potential conflict to the bullish technical story.
Got it. Finally, Palantir, PLTR, around $21.23. The data analytics, AI, often speculative name, always seems to be in the mix.
PLTR remains highly relevant due to its association with AI, government contracts, and its status as a favorite among retail investors and on social media. It's been volatile, but trending up recently.
What's driving its action today? What's the catalyst?
It's a mix, really. Ongoing AI hype and contract wins are positives. CEO commentary often moves the stock. But it also sees selling pressure from notable investors like Cathie Wood's ARK Invest, which adds doubt.
The meme stock factor.
Exactly. The report specifically mentions the heavy influence of social media and retail sentiment. Palantir is considered a meme stock, and those social media feedback loops can create rapid, emotion-driven price swings. Sentiment is definitely mixed here, a tug-of-war between AI optimism and underlying fundamental questions or large holder selling.
And the technicals and quants.
Technically, moving averages are bullish, but short-term momentum signals, the oscillators, are neutral, suggesting less immediate directional conviction despite the longer trend. Options activity is very high, and recent unusual trades lean towards calls, indicating speculative bullish bets are active. Institutional ownership is high, but has seen some trimming by major firms like Vanguard.
The report mentions that AI can even help simulate trader reactions to news for stocks like these. How does that work? Briefly.
Well, it's about tracing the chain reaction. For a stock like Palantir, if a major new government contract was announced, an AI simulation could process that news as a strong positive catalyst. It would then predict the immediate market impact, say, a sharp price spike on huge volume.
And beyond the price.
It could also simulate how that news would ripple through the options market, causing call premiums to jump, how social media sentiment would immediately amplify the bullishness, and how analysts' views might quickly shift. It helps cut through the noise and identify how significant news is likely to translate into price action based on historical patterns and market structure.
That ability to filter and identify those causal loops is powerful. It helps separate the signal from the noise.
It does. It helps distinguish a real signal from just another blip.
Okay, so we have the big picture, the dominant CPI event, the scenarios it creates, and these 5 stops, each with their own specific news and technical signals. But what happens when those signals conflict, like STRL's strong momentum clashing with an overbought technical reading, or INTC's positive trade breakout potentially being steamrolled by a negative CPI reaction? How do you resolve that?
This is where the analysis stresses the need for a clear hierarchy of signals. Not all information carries the same weight, especially in a fast-moving environment like the one we're in today.
So which signals matter most right now? What's the pecking order?
In this 24-hour window, broad macroeconomic events, specifically that CPI release, are at the absolute top. A significant surprise there has the potential to override almost everything else in the immediate aftermath, because it impacts the entire market's fundamental assumptions about interest rates and growth.
Okay, so CPI is king today.
Pretty much. That's the most impactful, recent, and widespread signal.
What's next in importance? Below macro?
Below major macro events like CPI are sector-level developments, like those U.S.-China trade discussions impacting semiconductors. Then come specific stock catalysts, earnings, clinical trial data anticipation for NVO, the credit facility for STRL.
And where do technicals fit in?
Technical signals like price patterns, moving averages, or indicators like RSI are vital for identifying momentum, potential turning points, and specific entry-exit levels, but they are generally less powerful than a major news shock. Sentiment runs through everything, amplifying or dampening the impact of the other signals.
So, that INTC example, a bullish technical breakout yesterday, but the analysis suggests a hot CPI today could easily negate that. That's the hierarchy in action.
Exactly. The bullish technical signal from yesterday on INTC was strong, but a hot CPI reading is a higher-level macro signal that would likely trigger a widespread risk-off move. Even with the positive trade sentiment, the overall market gravitational pull from a bearish CPI reaction would likely drag INTC down, at least initially.
Okay, that's the aha moment.
Right. Understanding this hierarchy, that a big macro shock can override a technical setup or a positive stock-specific event in the short term, is essential for navigating these conflicting signals. It's knowing which piece of information carries the most weight in this specific moment.
This brings us to the action plan. Based on all this analysis, how do you approach these 5 stocks over the next 24 hours, knowing it all hinges on that CPI number?
Okay, this is where the analysis becomes actionable. The report provides potential strategies for each stock, emphasizing that they are entirely contingent on the CPI outcome confirming a specific market scenario. For each stock, it outlines both a bullish and a bearish scenario with specific triggers, confirmation points, price targets, and crucially, stop-loss levels.
Let's look at INTC again. What does the plan say, specifically for bullish or bearish?
Okay, for INTC, in a bullish scenario, say if CPI is cool, confirming a dovish tilt, the trigger is price breaking above $22.50. Confirmation would be sustained trading above that level, ideally on good volume. Target 1 is $23, target 2 is $24.50, stop loss is below $21.50.
And the probability if CPI is cool.
The report assigns this scenario a 65% probability if CPI is cool in line.
And the bearish plan for INTC. If CPI is hot.
If CPI is hot, reinforcing the hawkish view, the bearish scenario becomes more likely, maybe 70% probability according to the source. The trigger is price breaking below key support around $21.80, maybe even $21.50. Confirmation is sustained trading below that levels on volume. Target 1 is $20.50, target 2 is $19, stop loss is placed above $22.30. You can see how the CPI immediately shifts the likely path and the probabilities.
Totally clear. What about NVO with that unique activist data situation? How does the plan handle that event risk?
For NVO, the bullish scenario trigger is price above $75, confirmed by sustained trading. Target 1, $77.50, target 2, $80, stop loss below $72.50. This has a 60% probability assigned.
And bearish.
The bearish scenario trigger is price below $73, confirmed by sustained trading. Target 1, $70, target 2, $68, stop loss above $75.20. Probability 40%. But the source really stresses that for NVO, the anticipation and the eventual outcome of that clinical trial data coming later this month creates potentially asymmetric risk-reward.
Meaning the moves could be much bigger than those targets.
Potentially, yes. A positive outcome could lead to a re-rating that goes well beyond standard targets, while a negative outcome could cause a sharp drop. The specific event catalyst creates unique dynamics there.
Understood. And the momentum names, STRL and CalM, quickly, what are the key levels?
Okay, STRL bullish trigger, breaking the 52-week high at $208.77. Confirmed by sustained trading on volume. Targets are higher from there, like $215, $220. Stop loss below $198. Probability 70% bearish. Breaking below key support at $200, $198, targets lower, $190, $185, stop loss above $209, probability 30%.
And call.
For call, bullish trigger, breaking out above $99.65 on increased volume, targets maybe $103.05, stop loss below $94.41, and quickly PLTR.
PLTR bullish.
Trigger above $22 on positive news or tech strength. Targets $23 or $25. Stop loss below $20.50. Probability 55% bearish. Trigger below $22 on negative news or tech weakness. Targets $19.50. Stop loss above $22.20. Probability 45%.
And the report ranked these before CPI.
Yeah, it noted that pre-CPI, some bullish setups like INTC and STRL looked promising based on recent action. But this ranking is highly dynamic and instantly changes based on the CPI result and the resulting market mood.
Makes sense. Beyond these immediate setups, the analysis also briefly touches on second-order effects, the ripple effects, right?
Exactly. How events can ripple out. For example, easing U.S.-China trade tensions on chips doesn't just impact chip stocks like Intel. It could lower costs for companies that buy those chips, like electronics makers.
Or the NVO data.
Positive NVO data could lead to broader insurance coverage for GLP-1s, impacting insurers and maybe even food companies down the line. And a hot CPI print forcing the Fed to stay tight could contribute to a broader economic slowdown later, potentially impacting small caps, even though they might seem cheap now.
It's about looking beyond the immediate price move to the wider implications, connecting the dots.
Exactly. The report also offers a quick pro-con look at some setups. For INTC bullish, pros include the technical break, trade catalyst, low short interest. Cons include that big CPI macro risk and some cautious underlying tech factor ratings we mentioned.
NVO.
NVO bullish. Pros are massive market potential, the activist catalyst, data anticipation. Cons are the binary nature of the data risk and high implied volatility making options expensive.
And the report highlights the importance of catalyst immediacy in this 24-hour window. What does that mean?
Yes. In a short time frame like this, setups with imminent high-impact news pending like INTC's sensitivity to CPI trade or NVO, driven by anticipation of data demand, immediate attention. General momentum plays are secondary unless they also have fresh, compelling news today. You focus on what's moving now. So to wrap up this deep dive, the market is at a pivotal point today, balanced on the edge of that May CPI data release. That number is the single dominant driver for the immediate future. U.S.-China trade relations add a key variable, particularly for sectors like semiconductors. And amidst this macro uncertainty, specific stock catalysts offer targeted opportunities, but you have to understand how they fit within the bigger picture and that signal hierarchy.
The strategic approach, as the analysis outlines, depends entirely on the outcome of that CPI data, favoring growth and momentum if it's cool, or defensives and caution if it's hot. It's very binary today.
The crucial part is the general approach for navigating these next 24 hours, outlined in the report. First, you must expect heightened volatility right around that 8:30 a.m. ET CPI release time. Be prepared for sharp swings and potentially adjust your position sizes accordingly.
Don't get caught off guard.
Second, always wait for confirmation signals before acting on a scenario. Don't jump in based solely on the initial headline number. Let the dust settle a bit. Third, strictly adhere to defined stop-loss levels. That's your safety net if the scenario doesn't play out as expected or reverses sharply.
Non-negotiable, really.
Absolutely. And finally, be prepared for dynamic reassessment. The probabilities, targets, and even the dominant scenarios are based on the information available this morning, June 11th, 9 a.m. ET. New information, like Fed comments later today or unexpected trade headlines, could require you to quickly reevaluate your plan. Stay flexible.
That preparation for change is key. It makes you think. In a market driven by these powerful, sometimes conflicting forces, macro data, news headlines, technical patterns, even social media hype, how do you weigh these different signals? When does that one critical piece of information suddenly override everything else you thought you knew about a stock or the overall market direction? Something to really consider.
That ability to prioritize and reassess based on the most impactful new information, following a disciplined, scenario-based plan, is what's essential in an environment like the one we're facing today. It's about adapting.
It's certainly a complex, fast-moving landscape we've broken down, highlighting just how much hinges on today's data. We looked at the big picture drivers, the key stocks to watch, and the potential paths ahead based on that crucial CPI number.
And things could look very different in just a few hours. Staying on top of the latest, most impactful information as it breaks is absolutely critical in moments like these.
And that's precisely what this deep dive is designed to do: filter the noise, get you the key insights, and help you understand the potential moves ahead. To get the fastest, most frequent updates directly addressing these market-moving events and how they shift the scenarios we've discussed, make sure you're subscribed. Don't miss how this plays out.